and it's going to be a very exciting session about the nexus between interest rates, banks, and politics. We're not going to talk about the immediate issues of interest rate hikes, which we see in different parts of the world with different central banks. The IMF has a lot to say about that, and Ruchir is part of that organization, but that's not the capacity in which he will be talking today. We want to look more at the medium term, and especially what we learned about low interest rates and the possibility that low interest rates may come back in the future. So we're not really in the short term immediate news flow. Actually, Marcus Bruner Meyer is notorious for many things, but including for having contributed to the concept of the reversal rate in a paper with Jan Kobe in 2018. And that's going to be one of our areas of focus today, I'm sure. So the first speaker will be Ruchir Agarwal, who is economist at the IMF, and also importantly right now, the head of the Global Health and Pandemic Response Task Force of the International Monetary Fund. Ruchir studied initially at the University of Michigan in Ann Arbor and at Harvard, where he got his master's in economics in 2008. And he also got his PhD in economics, also at Harvard in 2012. He then joined the International Monetary Fund, where he has contributed to a number of different projects and very important and internally acknowledged contributions to debates about monetary policy and macroeconomics, including the issues of interest rates, low or negative interest rates that we're going to discuss today. Marcus Bruner Meyer is, of course, the Edward S. Sanford Professor of Economics at Princeton University. He had an eclectic early career in the family carpentry business, in the German tax office of Landshut, which for me is a very exotic thing, and in the German military. But then he joined the economics profession by studying at the University of Regensburg, then at Vanderbilt University, where he got his MA, at the University of Bonn Graduate School of Economics, and then London School of Economics, where he got his PhD in 1999. Also in 1999, he moved to Princeton, first as an assistant professor and full professor in 2006. And in 2014, he was also appointed the director of the Benheim Center for Finance at Princeton University, which is a center created by Ben Bernanke in 1997. Marcus has too many academic credentials to quote them all, so I won't even try. He has received numerous prizes and awards for his pioneering academic work on finance and economics. He also has a lot of policy experience. He has been the senior Lamfalussy research fellow at the Bank for International Settlements in 2016. He has served in advisory groups at the International Monetary Fund, the Federal Reserve Bank of New York, the European Systemic Risk Board in Frankfurt, the Bundesbank also in Frankfurt, the Congressional Budget Office in Washington, and I'm probably forgetting many. He's the author of many books, including two recently, The Euro and the Battle of Ideas in 2016 with Harl James and Jean-Pierre Landau, and this year, The Resilient Society in 2021. And last but not least, of course, he's a non-resident senior fellow at the Peterson Institute, which he joined in 2020. With that, Ruchir, over to you.
Thank you, Nicholas. Let me just pull up my slides. Can you all hear me and see the slides at the same time? Excellent. Let me start by thanking Nicholas and the Peterson Institute for inviting me. And I'm very happy to be here with Marcus. Today, I'll be talking to you about work that I've done in a couple of papers with Miles Kimball, who is also in the audience. And also, before I start, just a disclaimer, the views here are not the IMF's views, but they are my personal views based on my research here with Miles and other work that I've been doing. Thank you. So what I will do in the 10 minutes that I have is give you a quick overview of the problem of the zero lower bound, why we should be worried about it, and what can we do about it, with also a focus on the bank profitability problem and the political economy issues around the zero lower bound. When I say ZLB, it'll be basically the zero lower bound, which effectively means being stuck at the nominal interest rate floor of zero or mildly or just below zero for a while. So let me start by showing you a recent history of interest rates in the Western world. In the blue here, you have interest rates from the Bank of England. In yellow, you have interest rates from the Federal Reserve. 3 points that I want you all to take away from this is we are, since the Great Recession, which is this area here, I hope you can see my mouse here, is basically we're in a new world where interest rates are much lower across all advanced economies now in many emerging markets. And this is a new world of the zero lower bound that we're going to be talking about. Second, this world of low nominal rates, because of lower decline in real interest rates and because of decline in inflation expectations, is expected to stay with us for a much longer period. So this is where, if you look at most projections going forward, interest rates are expected to remain at the short end in this corridor for a long period looking ahead. So this problem of zero lower bound is likely to be with us for much longer. And third is that this is something, a call for the international community, the macroeconomic community, that this zero lower bound has been a serious obstacle for monetary policy, and it is incumbent upon us to find ways to innovate monetary systems to overcome the zero lower bound, to restore monetary policy firepower, and that's what I'm going to be talking to you all about today. The main messages here is, as I just previewed, effectively is to avoid serious crises, it'll be desirable if central banks can basically make the zero lower bound problem a non-issue. And despite what central banks are doing, we know shocks will happen, and we need to be prepared for shocks in the future. And lastly, inflation is costly, perhaps less costly than recessions, but costly nonetheless. And adding negative interest rate policy to the toolkit of central banks can mean possibly that we don't have to raise the inflation target or even potentially lower it to zero. So that's what I'm also going to be talking to you about today. In the next few minutes, let me give you 3 reasons why we should be worried about the zero lower bound. And then in the remaining few minutes, I'll talk about what can be done about it. Why should we be worried about it? First, there is indeed limited monetary policy firepower. What that means is, in recent recessions, if you look at around the world in advanced central banks, they've cut policy rates by 5 to 6%, typically. But today, with most central banks having their policy rates close to zero or mildly below zero, there's basically very little room to provide such stimulus in the next big shock. And we already see that in the central bank's response to COVID. Basically, on the x-axis here is what the policy rates were at central banks before, at the onset of COVID, and what was on the y-axis just shows you the size of monetary stimulus that central banks were able to provide. And basically, central banks were at zero or below ended up providing almost no monetary stimulus directly to the interest rate channel, whereas those that were further away had larger rate cuts. So we know already that the zero lower bound is proving to be a serious obstacle for monetary policy. Second, these episodes are expected to be more frequent and severe. So Fed economists, Kiley and Roberts, estimate that we could be at the zero lower bound episode 30 to 40% of the time. And that already is becoming true if you look at the recent history, even since then when they made those simulations. And these episodes are expected to be severe because basically we're not going to see quicker recoveries. And so the cost of being at the zero lower bound every time there's a downturn is going to be larger. And despite all the inflationary pressures that we're seeing now, if you look at markets' expectations going 1 year ahead of where the rates are expected to be, we're not going to be anywhere close to where we were before the Great Recession. We are likely to stay in this corridor even after this large inflationary pressure we're seeing around the world. Third point is we should worry about it because of the central bank credibility and trust, which is under pressure. Persistently low rates, so the low for long, that's called out there, which is combined with quantitative easing, instead of what we are proposing, which is short-lived, deep negative rates, bring the economy back to full potential and go back to normal rates. That low for long has also brought central banks under criticism from the entire political spectrum for either doing too little balance sheet expansion, for doing too much balance sheet expansion. And effectively, central banks are now being blamed wrongly for controlling. There's a perception out there that the central banks can control the natural interest rate in the medium run. So that is something that is quite important from our perspective, to expand the monetary policy toolkit to restore also central bank credibility and trust. So as we see it, monetary policy going forward, the future of monetary policy systems, by expanding the toolkit to allow negative interest rate policy through paper currency policy, I'm going to define that in a second, can open up new possibilities, and these can be quite attractive. Now, what are these paper currency policies? So that's basically the last few minutes I'm going to be spending talking about, is how can we break the zero lower bound? And what does it mean, the electronic money system? Basically, the zero lower bound arises when the government issues pieces of paper that guarantees a 0% nominal interest rate over all horizons that one can obtain in unlimited quantities. What that does is it acts as a floor on the interest rate, making people unwilling to lend at any rate significantly below zero. That's the problem. And so all roads to attack or overcome the zero lower bound lead to effectively creating a negative paper currency interest rate, PCIR paper currency interest rate, which is the interest on paper currency to be something other than zero. And effectively, this kills this arbitrage opportunities between keeping money in the bank versus holding paper currency. Now, last, let's say, substantive side in terms of the technicalities of how to do it is in our version of how this can be done. This is in joint work with Miles Kimball, is we have 3 steps in which one can enable deep negative rates when needed to fight recession. So first, at the central bank cash window, which is the window at which banks get cash to stuff it into their ATMs in exchange for electronic dollars. Most people don't even know where this is because it's such an arcane part of central banking. Basically, at that window, we are proposing effectively in our system that central bank can take a localized action to create a negative paper currency interest rate at that cash window. So this can be done in our system either by depreciating paper currency relative to electronic money, or by charging a rental fee on cumulative withdrawals of cash. So it can be done in 2 ways. We call the clean approach or the rental fee approach. I'll be happy to talk about that in discussion. Once that's done, you leave everything on the price system. You let the banks be free to choose on how they transmit this paper currency interest rate to the rest of the economy. And third, very importantly, which is the subject, also the title of today's conversation, is the political and bank profitability problem. In our view, it can be largely handled, although not fully eliminated, by ensuring that bank profitability can be shielded and households can be shielded, regular households can be shielded from this negative rate by giving a subsidy to banks using the interest on reserves formula, so that banks can effectively ensure that no household effectively sees a negative interest rate on their checking or savings accounts. We know banks have been able to transmit negative rates to institutional depositors, to money markets. The problem really is these regular households, and we think this can solve the problem. So those are the 3 steps. And in fact, the heroes in our book of the innovation in central banking are the central banks that had to deal with the practical aspects of these implementation. And the central banks today, the large major central banks that are at mildly negative rates, are already using various tools like the interest on reserves formula that I mentioned, or even negative lending rates. So the ECB with the new TLTRO, banks can borrow at negative 1%, which is 50 basis points even below their deposit facility rate, all ways in which to protect the margins and ensure that the bank profitability problem does not become severe. quick note on, I know we want to talk a little bit, and Nicholas wants to talk about bank profitability. Very quick note on that. So far, the evidence suggests that we need to do this assessment on a per unit basis, right? The negative, we're negative 10 basis points or negative 50 basis points. But so far, the mildly negative rates have had not significant effect on bank profitability. There are some pockets where there are, and we can talk about that in discussion, but I just wanted to put a plug in that for discussion. Last slide, key takeaways. In our perspective, the world does not need to suffer through 2008-16, where we had a very slow recovery in most parts of the world. In our perspective, with readily available tools, a central bank can enable deep negative rates whenever needed, thus restoring monetary policy firepower. And not always to go negative is the same. In our proposal, basically we focus on two approaches, the clean approach and the rental fee approach, which is at the minimum distance from the current framework. At the same time, it can mitigate, although not fully eliminate, political costs and largely eliminate concerns about bank profitability. Let me stop here and turn over to Marcus. Thank you.
Thank you very much. Very enticing introduction, Marcus.
Thanks a lot, Richard, yeah, and Nicola. So I would like to make some 5-6 points just to put in perspective. I like the proposal a lot. I think it's a very creative way to approach the problem of the zero lower bound, but I would like to question certain things as a discussant. The first thing is, of course, traditionally we relied a lot on monetary policy to stimulate the economy if things slow down. But perhaps we have to shift more to fiscal policy. So there's more, once our star goes down, we have less room on monetary policy front, but we have more room on the fiscal policy side. And some people might even argue that, stimulus checks, that's actually what helped us to bring the inflation up again. So monetary policy was not very effective bringing inflation up, but the stimulus checks in the US did the trick. And so perhaps we just have to readjust our whole policy framework beyond monetary policy. But I know that that's, you want to preserve the power of monetary policy. I'm also in that camp, but I just wanted to say that. So the second thing I wanted to say, once you introduce your scheme, so cash becomes slightly a different currency than electronic money, and including, I guess, the digital dollar or the CBDC and things like that. And I was wondering, once you give up the uniformity of money, that you have different monies out there, what's my unit of account? Which unit will people think? Will they think in the cash units? If you go to the store, will it be priced in two prices? So here's when you pay with cash, and here you pay with electronic money. And how does it impact the trust in money? I think money is all about trust. Once you have several units floating around, is there some danger about that? My third point would be that you emphasize very much, how to deal with cash, and the zero lower bound comes all from cash. And in Europe, when they introduced the negative interest rate, and there was a survey conducted by the CESIVO Institute, what really triggered people. So what they found is that if the interest rate goes towards zero, even negative, people switch around across bank accounts. So it is really the case that the deposit holders, they become much more surge active. So the market power banks have on the deposit side is really eroding. And that you address this in the profitability, but it's not really coming from the competition through cash. Once you go in the negative interest rate, it's really the competition among the banks becomes much more severe. And, especially also institutional investors, they'll look around which bank is offering a high interest rate, while if it's between 2 and 3%, they don't really care. But if it's between, 0 and minus 25 basis points, they care a lot. So the switching costs are essentially much lower, or the intensity of competition, the degree of substitutability is much higher if you go for lower interest rate. And I was wondering how your framework would address that. Of course, you could say it falls in the same category as the profitability of the banks, but this makes, of course, for the banks a much more difficult situation. You might also argue that, with fintech and with all digital money coming up, that's less of an issue. Then I wanted to also ask you about, if you look about the zero lower bound in the US, In Europe, it's a very, bank-focused. Profitability of banks are important. In the US, the reason why the Fed didn't really go negative is because of money market funds, and they're breaking the buck rule. How would your framework interact with that? Can we go negative and then the money market funds go under because they can't cover their fees, or we have to get rid of the breaking the buck rule, which politically was not feasible? I mean, they tried very hard, and it was always blocked through various measures.
Allow me to interrupt Marcus here, but for our non-American audience, breaking the buck is this idea that money market funds which have a unit value, so they're always worth $1. If there is a decrease in that value, they can no longer be worth $1 and give the saver the surplus. So that's what is called breaking the buck. Sorry.
Very good. Thanks, Nicola. I forgot about explaining that. And then you also mentioned, we can go to an inflation target of 0 inflation. So typically I like lower inflation, but I'm a little bit worried, if you have an economy with wage stickiness and people are very reluctant to have nominal wage cuts, and we see that. Can you really go at an inflation target of 0? Because that's independent of the 0 lower bound policy. You might not, for other reasons, say, okay, a 2% inflation target might be better than a 0 inflation target. That's just a side comment because you also mentioned this in your presentation. And I also would like you to make a case saying, okay, going negative, big time negative is superior to have all these non-conventional monetary policy measures like QE, forward guidance, and all the other elements. If you could elaborate on that. I very much like your thinking on, tiering and how you essentially can have a marginal negative interest rate, but the average negative interest rate for banks is not really so negative. So still the profits is preserved. And as you pointed out, in Europe, this was really cleverly played in a sense that bank profitability is reserved by saying, okay, if you want to go €1 more, then you have to have a high marginal negative interest rate or very low negative rate, and but on average it's not so bad because of other measures like the TLTRO and the funding scheme, which I hope Nicola will explain if we need to explain. It's essentially how the banks can borrow from the ECB if they extend their lending to the real side. So let me leave it at this. Perhaps I threw out too many points, but I think this perhaps can open up our discussion. Overall, I like the scheme. I think it's interesting, but I'm worried about certain elements and to be discussed in the next few minutes. Thanks again for having me, and I'm looking forward to it.
Thanks, Marcus. And I guess it's only natural to ask Euro-Chair to react, but very briefly to not all, but just some of the points that Marcus made in order to start our conversation. And in the meantime, of course, I encourage the audience, as usual, to send questions through the Q&A tool on Zoom. Thank you.
Right. I think the points Marcus is making is quite important, especially the first one that you've made is the relative importance of fiscal policy versus monetary policy. In our view, there is a reason why until we reach the 0 lower bound, the profession had converged against monetary policy as an important tool because it's technocratic, the delays are smaller. And what we want is the parliaments around the world should be focusing on the really hard, challenging problems of the long term, low productivity, aging, immigration, climate change. Those are the issues which are the really hard problems. At the end of the day, ideally, the parliaments of the world should not be also focusing on providing near-term stimulus, where that can be done by a technocratic institution like the central bank, which works. And the other benefit of monetary policy, as you know very well, is it does not add to the national debt. It creates space for other infrastructure investment, other health spending. That's very important. And so as we see it, that distinction is quite important. And that's why it's quite important to focus on monetary policy. On your second point, very quickly, totally unit of account. The key issue is the unit of price stickiness. The unit at which prices are set has to be electronic. Already, most transactions are electronic in much of the advanced world. So that's an issue we can definitely discuss more. That's exactly your spot on there. The trust in cash point is also quite important. Effectively, as we see it, because by shielding the regular households from negative deposit rates, you avoid all of that such active behavior, because basically you don't want regular households to even be thinking about this. You want them to go about their lives as if nothing has happened so far. And then on the money market mutual fund point, one of the good things that we have seen across all the jurisdictions where rates went negative is very strong pass-through in the money market rates, and also very strong pass-through for large institutional depositors. So in a way, as long as the money market rates and the asset markets have good pass-through, then the issue becomes of net interest. The problem becomes largely focused on the stickiness of household deposits. So I'll be curious to know if there is more on that point than what this response handles. A quick last thing on the inflation.
No, on that one, I understood it to be a US-centric point, right? Because there aren't that many constant asset value funds outside of the US. Is that correct, Marcus?
I mean, the money market funds are, but the regulation, which is part of the SEC regulation, that's not outside of the United States. That's my understanding.
Well, the question is effectively if the institutional depositors and money markets, there's strong pass-through of negative rates, the interest rate environment they're operating in, basically they don't have this arbitrage opportunity. So effectively, that should not be any different than a rate cut in the positive territory from that perspective. Mm. The key issue happens is whenever an institution is unable to pass the negative rates to a set of liabilities, like household deposits, regular household deposits. So I'd be just curious to understand why specifically the folks that put the money in the money market mutual funds will not be operating in the same negative interest rate environment. So that maybe I did not fully get that.
Do you want to say a word about that?
You ask me, or? So yeah, so that's purely a regulatory or a question. My understanding is at the moment it's such that the money market funds don't have to pass on so they're guaranteeing essentially that you don't lose any value if you invest in nominal terms. So they cannot really charge a negative interest rate. And then there's the issue that they have to cover their fees. So that's why the Fed never went, they went between 0 and 25 basis points, but never to 0 even, in order to cover the fees of the money market funds. And they were very concerned that there might be a run on the money market funds, destabilizing the whole financial system. And of course, you can say we changed the SEC rules. They can just pass on negative. They have perfect pass-through. Then it would be solving that. But the Fed tried very hard, but there was a lot of political resistance and was not able to do so. That's my understanding.
Because I remember after what happened in September, October 2008, there was a lot of effort in that direction. And the problem still exists, right? Yeah. 13 years later.
So, but, if you can lift this regulation, then it's safe. Then you can do it. But I was just outlining a political economy issue, which you have to overcome. But can I ask another question? Is it okay? Or
yes.
I was wondering if you can elaborate a little bit on the cash holding of households, because aren't you subsidizing cash holding? So if I think about it, I'm a household and the interest rate is negative. My checking account gives me a negative interest rate. But if I have my cash and leave it under the mattress, I don't have a negative interest rate. Wouldn't I withdraw a huge amount of cash? Of course, you will say probably banks suffer from this because the banks have to get the cash from the central bank. And they will disincentivize me, they will somehow punish me, but I don't see how the banks would do it. Or how would you make sure that the household say, okay, I will store a lot of cash under my mattress?
That's exactly.
I have the same question, and I would add, my understanding of your thesis is that you think one can go deep into negative rate territory, right? Deeper than has been done so far. So then how deep is really deep? And if you go into several percentage points, then this subsidy for cash becomes very, very significant, right?
Yes. So actually, that is exactly what the proposal does. Is as in the simplest, in the clean approach, if paper currency is is earning a rate of interest which is the same as money in the bank. So suppose the interest rate is -2%, and the paper currency is earning also -2% over the same period. There is no arbitrage because basically, even if you put the money under the mattress, you will be getting the same rate of return. So there's no incentive to pull money out of the banks. Now, how would you actually implement that? Effectively, in the clean approach, it's easy because the rate of depreciation should apply to cash anywhere in the system, so it becomes just like any other asset. Now, for legal reasons, one may not be able to depreciate paper currency as over time relative to paper currency, electronic money. You may want to do it as a rental fee approach. What that basically means is, imagine in your example, Marcus, how would the households get their hands on cash? They would have to go to the banks to convert their deposits into cash. And where would the banks get the cash? The banks would have to go to the cash window to basically convert the electronic money into cash. And as long as the banks have facing that paper currency interest rate at the cash window, then it becomes incumbent upon the bank basically to pass that on to the household deposits. Now, it is not as clean as the clean approach, because then it gets into issues of, and we have a long discussion of that, which is how do you allow households to have enough cash withdrawals for regular needs, right? So you can have some exemptions, but basically that's you enter into those kind of issues, which are more practical aspects of implementing the.
Can I ask you? So there's this issue of dollarization, and I can imagine an issue of cashization, that the household just say, now I buy real estate with cash. And of course, I think what you have in mind is that, the supermarket will have a digital price and will have a cash price. And over time, the milk will become more and more expensive paying it with cash. But let's suppose the economy decides, we don't go with that. We just decide on our own. We switch from the electronic money as our unit of account to the cash as a unit of account. And there's a dollarization, or what's a cashization or dollarization in a sense. How would you prevent that?
So that is exactly the issue, which is to ensure that the unit of account remains the electronic money. The good thing is, since in most advanced countries today, and now growingly so in emerging markets too, a large fraction of transactions are electronic. You cannot pay with cash on Amazon, for example. You can probably find some innovative ways, but it's hard. Since most of the transactions are electronic, and also a large part of transactions are with the government, like paying taxes, which are effectively which is controlled by the government decision itself. So we have a discussion on that, which is quite interesting. Is you can imagine a world where, for legal reasons, you wanna have the cash that is already out in the world that can be used at par, but all the new cash that is issued is going to be the paper currency interest rate will apply. That would simply create basically two parallel assets, but the key, most important point there is the supply of these cash in the wild, we call it, is finite enough to not be able to create a zero lower bound, because effectively it will be just an asset for which the price will adjust, which is an asset in finite supply. So the key point is it requires a lot of trillions of dollars of assets so that's the key point on the infinite supply for one to be able to break the zero, to create a zero lower bound. Yeah.
I think the politics of this, of course, would be an interesting thing to discuss, and the acceptance by populations. It makes me wish I had invited people from countries like Venezuela or Lebanon to attend this session. But I have there is a question in the Q&A from Mark Dabrowski at Bruegel, who says, what are you talking about? We're in an inflationary environment, not deflationary. So maybe Marcus first and Ruchir second. I mean, we've said that we wanted to have a more medium to long-term perspective, and in a context where issues of deflation may come back. But Marcus, can you give us your take on why this discussion is interesting?
Yeah, I think so. So Marek is right that we have now an inflationary environment, and probably we might come back later on and say, oh, was it nice to have this low inflation, and gives us so much possibilities for the central banks to do QE and stabilize everything. And with a high inflation, they don't have the power anymore, and we probably will have some sentimental flashbacks. And that's very much challenging. But nevertheless, I think it's worthwhile thinking that, you know, how can the zero lower bound drive or limit our monetary policy power? So we might come back, and we still have a situation in Japan where we're still struggling with that. So if you look across the globe, I think we still have some thinking to do in order to resolve this. So what we're going forward to, we have a much more heterogeneous world. So we have countries where there's a lot of deflation still going on, and some other countries where we have, or most of the countries, we have inflationary problems. And so nevertheless, I think it's applaudable for theorists and for economists to think it through and come up with different approaches to handle that. So that would be my answer at this stage.
Sure.
Yeah, so exactly as Marcus has said, I think it's important to recognize that the inflation dynamics are different in different countries today. Second, and actually this is a worrisome thing, if you, despite the very high inflation in some place, much higher inflation in some places compared to what we've seen in recent periods, the interest rate world stays very close to, is expected to stay close to zero. What we're worried about is effectively monetary policy should become as boring as possible so that we can focus on the real problems of the long-term productivity issues. So as much as possible, we can expand the central bank toolkit to be able to fight future recessions, then we are in a better place economically. One last thing, and this is a point that comes out a lot in Marcus's research, is all the cost of low interest rates or negative rates depends on the health of banks. More bank capital means fewer problems. These, in good times, it is important that we build those capital buffers and be prepared for so if we're already in a recession and we're having this conversation, then it's too late.
And of course, that would lead us to different discussions about banking crisis, but that's not our focus today. There's a question from Greg Smith about asset bubbles, in a way, resulting from zero lower bound. And he asks, does that lead to asset bubbles in equities or in the property sector? Inequality rising, billionaires profiting. How do you see that aspect of the political equation? And is it possible to mitigate these distributional consequences of what we've been through in practice?
So I think generally low interest rates make the whole economy prone to bubbles. In particular, if the interest rate is below the growth rate, we have some bubble problems. And I think we have to look out for that. And we see a lot of financial instability building up at the moment. So, and I think that is very worrisome if you look at the current situation. And I think I just want to reiterate what Ruchir said, is that we really have to build up buffers now. I think if there's something coming up next year or something, we should have the buffers ready in order to, be prepared for that. And the lower you go with
isn't Marcus on this, isn't that the case? I mean, we've implemented all these Basel standards, and there is a lot of increase in the capital ratios of banks in most jurisdictions compared to what they were before the crisis in 2007, and certainly after that crisis. Do you think that this is insufficient, or are you thinking of specific macro-prudential actions to come?
I think it's insufficient in a sense that the whole thing the problem shifted out of the banking sector to the shadow banking much more dramatically. So there's a lot of embedded leverage if you just look at the issuance of corporate bonds last year, and so it shifted out of the traditional banking sector, the shadow banking, the corporate sector, and then in the crypto space. So we have a lot of areas where there's a lot of financial instability risks there, and we have to, figure out how to touch on these areas as well. So I'm not arguing that we have to tighten the banks right now, and we didn't do anything for the last 15 years. But I'm arguing that it moved to other areas, and we have to be much more watchful for that.
And sorry to insist on this, but this is very important. Isn't it the case that in these non-bank areas, there is actually more loss absorption, that investors in those instruments are more capable of absorbing losses than investors in money market mutual funds, as we discussed with breaking the buck, let alone depositors?
This depends a little bit. If I take the crypto space, it's true. I mean, generally you can, put much more losses there. But as you open it up to retail investors and you connect the crypto space to the real economy and to the regular financial system, then you get the same problems as you have in general. So the loss absorption capacity is not really. And let's suppose we had a huge financial crisis. It's also then will be immediately a political crisis. And the question is whether the Western democracies would survive another great financial crisis. Now that's a huge downside risk. And that's actually what the financial regulators at the moment should look at, the responsibility they have essentially in the bigger scheme of things. And that's I think, one thing. But I agree with you in general, if with professional investors, as long as they themselves are not levered highly, they can absorb more losses. And there's more loss absorption capacity. But if you go to small retail investors speculating in all this, then it will also create political unrest. So the loss absorption capacity might be there in terms of being able to absorb the losses, but it might lead to a lot of unhappiness in the population.
Sure.
Maybe I can make 3 quick points building on what Marcus has said. Of course, asset price inflation and bubble issues are an issue of the natural rate, and is something that is fundamentally has happened in the real rates have fallen and these have gone up. So we should be careful to not blame that on central banks that are responding to that rate. Second, it is indeed one of the challenges it does pose, low rates, is this risk of zombie lending. Basically, if you're lending somebody at very low rates and they have to pay 0% interest back, suppose, it's really hard to know the true position of these firms. So it does require us to be more innovative in thinking about prudential policy. So requiring more amortization, so you can have a check on the health of the firms, and thinking a bit differently on the loan migration formula. So that would be very important. And exactly as Marcus is saying, this is a financial stability tools, prudential policy, macroprudential policy are complementary tools as we see it to negative interest rate policy. And applying them in a coordinated way can get you there. If I can say one last point, actually the housing prices is a great example of why that's an issue of higher prices often is limited supply and zoning and overregulation. That is something we want parliaments of the world to focus on. And because then you can, if you can provide larger supply, especially in low-income areas, then we can solve the pricing problem. But if Congresses and around the world are focused on providing short-term stabilization, there's less space for talking about those type of issues, which are really the critical problem for the long.
I guess if you talk to parliamentarians, they will tell you, who are you to ask to tell us what we should focus on? If we want to focus on short-term stimulus, that's our right, no? I guess you have those conversations.
Oh, definitely, but I would say very importantly, at least in most parts of the advanced economy, there is an order of central banks having independence and being tasked with the mandate of often the mandate of price stability and full employment. So that is exactly the role. And in a way, if we prevent the central banks to have that expanded toolkit, we are basically operating much below our ability to respond to shocks in the world. So our focus is, let's restore the monetary policy firepower so central banks can do the job, and then we can collectively, as a society, focus on, exactly as Marcus says in his Resilient Society book, focus on the real harder problems that will raise long-term productivity, raise the natural rates, and effectively offset some of these asset bubble problems.
I'd like you to come back to Marcus's last point on 0% inflation target. I was also struck by that, and I think my Peterson Institute colleague Olivier Blanchard is not in the room, but clearly that goes against some of the discussions that were held in the last 10 years, including inside the International Monetary Fund, in terms of how to think about inflation targets. And as Marcus said, you may create some maybe undesired dynamics in labor markets. So can you elaborate a little bit on this? In what sense would a 0% inflation target be superior to a 2% inflation target?
The key point here is just since you mentioned Olivier Blanchard, who also was one of my former professors, so with respect to his ideas, one of the ideas out there to fight the zero lower bound is also due to Olivier, is to raise the inflation target to something like 4%, effectively basically reducing the need to cut rates into negative territory. What we know already from the episode of higher inflation around the world today is inflation is costly. It's a reminder to the advanced economies, which have not experienced higher inflation in a long period. It is costly, it has distributional consequences, it has an impact on inclusive growth. And our point is, do we, as macroeconomists, is incumbent upon us to ask, can we restore the ability of central banks to fight recessions without bearing the cost of higher inflation every single day if you have a higher inflation target of, say, 4%. So that's the idea, let's say the intellectual foundations behind the idea of going for a lower target. Now, what Marcus's point is...
Wrong with the 2% as opposed to 0. I mean, nobody has really taken up in rich economies the 4% idea.
Right. So
why change from the current consensus around 2%?
Well, that's exactly. So let's say this way. Very clearly, there's the fact that Olivier, for example, is pushing for the 4% inflation target means he very rightly recognizes that zero lower bound is a problem. Now, the solution they're offering is to raise the target to, say, 4%. What we're saying is that solution comes with a cost of accepting higher inflation. So if we collectively agree as the economic community to do something about the zero lower bound, can we do it without imposing a cost of higher inflation on the general public? That's where we're coming from. And that's the motivation behind even asking or starting the debate on why can't we go to a 0% inflation target. And effectively, if the central bank can go, imagine a world 30, 40 years from now where there's no cash. In that world, effectively, we'll not be having any of these discussions because basically the central bank can choose very quickly the nominal rate to make sure that the economy can be restored quickly to make sure the nominal rate equals the real rate. And effectively, then the whole discussion of what the right inflation target will be very different. We are having all this discussion today.
But that's kind of imagining the problem away, right? Marcus, do you think we'll ever get to a point where cash has disappeared?
Yeah, so let me first answer about the inflation target. So I agree, the main argument for having a high inflation target is because of zero lower bound. The fact that we actually can go negative, and many central banks have shown they can go negative, I think limits this argument. What I really like about an inflation target would also throw in a new consideration, which is like, it should be a worry-free inflation. So what I want people to live, they shouldn't live thinking, oh, I have to think about inflation and now I have to worry about high inflation and how do I calculate it. As long as between 0 and 2%, I would say, you don't have to worry much about inflation. So you can just focus your cognitive abilities on other things in life. There's so many things to worry about in life. And the ideal thing is to keep inflation worry-free, so nobody has to really care about that. I think that's in my view. So once we go, let's suppose there's no zero lower bound, I think there still might be some nominal rigidities on the wages. So people don't like to have a nominal wage cut. I don't know why it is, but they're not really happy with that. And so even if we don't have any cash, then this might still be there. So if you say you want to favor some workers who are very, hardworking and give them a wage raise and others less so, it's somehow easier to give a real wage cut than a nominal wage cut. And that's where, you get an inflation target, which might be slightly above zero, not necessarily exactly zero, even without zero lower bound. About your final question, will cash go away? I cannot foresee. I can see always some at the back, and there might be some cash for really privacy reasons and other reasons, safety reasons, where people feel more comfortable to have something. Nobody can really follow up what I'm doing with that. And it's a small amount, and there's some safety buffer, and there might be some cash, but it might not be the same dominant force it is now, and also, determining to some extent how much you can.
Perspective cash will still be there to buy chocolate, so that nobody knows that I have that
advice. One quick thing on the privacy issue, which is quite important. May I? Sure. I think one of the advantages of the proposal that Miles and I have been proposing is we keep cash around for precisely to allow. There is a privacy benefit to cash. There is a benefit for the unbanked. We don't want to basically. In our system, cash is there. We just want to make sure that cash gets the same rate of return for people who are putting money in the bank, which is very different than proposals out there like Ken Rogoff and others had originally proposed, which is retiring large bills and over time kind of potentially removing cash. So we think there is a benefit for cash, and we don't want to be making a judgment on that privacy issues. We want to allow cash to circulate while solving the zero lower bound problem.
There's a question from Paul Chu, which is asking about government financing in all this, and he's asking whether the speakers can comment about the systematic risk and the management under zero lower bound and worsening governmental borrowing over the world. How can this impact be minimized, and how worried should we be about this interconnection between government indebtedness and the level of rates?
So in general, it is the case that we face this huge government debt levels at the moment, like this after the Second World War, and we have to find some ways to build up new resilience, because if you get another pandemic or cyber attack or something, we have to have new fiscal space in order to act on that, or also monetary space. And that's so we have to find some ways to in the long run to build up some buffers again. And I'm not sure whether really imposing negative rates or anything will be the way to do. I mean, there's of course one approach would be some financial repression, and that would be some form of negative rates. I can see that if you impose huge negative rates, you can actually impose a lot of losses on the banking sector. If the banking sector cannot pass it through, that's one way to do it, but this creates financial instability. And there might be some push in that direction, but I don't know how large it will be, because you immediately open up financial stability issues. And that's what I call this financial dominance. Now, you cannot push too much of the losses in the financial sector, cut interest rates too much, because you really create financial instability. So I'm not sure how much room there is. Of course, if there's a slightly, and some people think slightly higher inflation, you will, and keep the nominal interest rate low, you can actually erode the debt level to some extent. I'm not sure how long this will take until the public realizes that, and then the long-term rates will go up, the nominal rates will go up. So, but there will be a combination. There will be pressure through inflation tax, financial repression, and other taxes to get to a more reasonable amount of debt levels. Or one could say, given that the interest rate is so low, we can just live with a higher debt level all the time. And this is the big debate of our times. And the debate is still open. The outcome is still open. We will not find out until when we have another big shock, whether we then have or have not the reserves. And I think there will be certain countries which will easily handle it. So we can issue safe assets like the US or Germany or Japan. They can handle it. Others might not be able to handle it. And so they have to be more careful. Again, we end up in a more heterogeneous world across the globe.
Have you been surprised at the relatively low pace of sovereign debt problems since the COVID-19 shock, and how do you see the outlook for that? Marcus, maybe first.
It's coming up. So the sovereign debt issues will come up. This will be one of the big issues in the next year. So we have seen certain emerging economies, like you had some debt restructuring. There will be more debt restructuring coming up. It's just for political reasons the can is pushed down the road. But we will have to face these issues of the high debt levels, especially in countries who can't issue safe assets. And so this will come up. This will, keep probably your webinar series busy in the next year on these issues. And we have to see how this plays out. And that's why, it's very important to have a good framework in place where we can actually figure out how to handle this, come up with creative solutions to handle this challenge for the next few years.
Root shares, that's the core business of the IMF, isn't it?
Well, as I said, I'm not here on behalf of the IMF, but I think what Marcus is saying, which is very, very important, which is, and in fact, Marcus has answered his own first question that he posed to me, why we cannot just put all the burden on fiscal. Debt issues will come up. Just putting the burden on fiscal authorities add to the debt limits our space to act in the future. And I would say it is incumbent upon us, exactly as Marcus is saying, to imagine more, to be more creative, to have the framework in place for the world to handle shocks. We know these are shocks are happening frequently. We know when these shocks are happening, we have limited space and we're staying in this for much longer. And we need to do more and better on that.
Chris, I mentioned in the introduction your paper with Jan Kobe 3-4 years ago on reversal rate. Can you give us a sense of how much you've evolved in the last few years and how you look back at that research and the whole notion of reversal rate, kind of in contrast with Rucher's proposals?
Yeah, so I think it evolved somewhat, but the core message is still the same. So the argument was essentially you can cut interest rates to a certain level, and if you were to go below that, it becomes counterproductive to cut interest rates at the short end. And one main driver of this is, you erode the profitability of the banks, and then, the pass-through is really a problem, and then you actually get less lending in the real economy, and you don't stimulate the economy anymore. And the key message was essentially, you really have to look at the country. It's different from country to country. So the reversal interest rate might be -1% for the euro area, might be a very different rate for Sweden and so forth. So if you go across countries, it's very different. And what are the inputs? What you have to look for where it is lower and where it's higher? And, it comes, wholesale funding comes in, but one driving force is the capitalization of the banking sector. And that's where the interaction with market potential comes into place. So if you have a well-capitalized banking sector, then you can go much lower. So that's one main message, and it has really stuck the same way. And the second main message is that the creeping up effect, as we call it, that the lower you stay low, the worse it gets. So the reversal rate is creeping up. So you can go low quite a lot for a short while, but you can't really stay low to be effective for a long time. And I think that's, we're seeing this too. Of course, what we saw now with COVID is a huge stimulus and things are thrown in the air. So, but I think as a response, or perhaps also for other reasons, the central bank community came with a clever schemes, in this tiering also what Roger mentioned. It's a way to push the reversal rate even further down, essentially to make the marginal interest rate much, much negative, but the average interest rate is not so negative. And that's a clever way to be able to expand the monetary policy space. And I think that's a clever way of doing things, and that helps to have a bigger space.
To conclude, do you think we'll see policy rates at minus several percentage points in the next 10 years, the next 20 years, the next 30 years? What kind of time horizon are we talking about? I know it's an impossible question, but I'm asking it anyway.
That's for me. That's for me. Okay.
Yeah.
Can I say one quick thing on Marcus's reversal rate paper? I think a lot of people have it's one of the best titles one could choose. So Marcus, kudos on that to you and Jan, because I think it's really has shifted the way people think. But I think I would encourage more people to read his paper, because exactly as Marcus is saying, there are problems of this creeping of effect, which being at low for long. And second, there are tools available, exactly as Marcus said now, that central banks can protect banks' capitalization. So these reversal rates can go much deeper. So we should not imagine central banks to be boring, that they're not going to use the tools they're already using to handle bank profitability, because that's exactly what we should be doing. We should not be saying because of reversal rate, negative rates cannot be done. We should be saying, how can we write models that take into account tools central banks have in place to allow the reversal rate to go much, much lower into negative territory?
When do you expect we might see them?
And when we expect, I think that exactly depends on a few things. First is the economic profession working more on this research agenda. So I would invite us to do more on that. Second, very importantly, there are legal and communication challenges that we need to understand and think about more. Already the questions that are coming up here are exactly illustrative of that. We need a way to make sure that we can overcome the political economy problem and the bank profitability problem. And once we can do that, this can be implemented overnight based on the tools that we have set. So it's really an issue of imagination at this stage, as I would say, and work on the political economy and communication issues. Yeah.
Really an issue of imagination. That's a fascinating way of concluding this session, but not concluding the discussion, of course, on negative interest rates. As Mark Dombrowski reminded us, not really the current discussion, but one that may come back sooner than some expect. Our next session will be on something we have briefly mentioned at some point today, which is emerging markets and the risk to emerging markets, especially with shifts of sentiment in the investor community between risk-off and risk-on phases. And there's fascinating research by Anusha Chari, who will present, and so that will be in 2022 on January 12th. The second speaker will be Alejandro Werner, who used to be at the IMF, but is now also at the Peterson Institute. In the meantime, many thanks to our two speakers, Ruchir Agarwal and Markus Bruner Meyer, and maybe not least, happy holidays to all of you in the audience, and also our speakers, and Jessica, and all the people who at the Peterson Institute make this series possible. I'm not going to mention them all, but I'm very grateful to each and every one of them for the support, continuous support through the life of this series, which will continue next year. Happy holidays. See you very soon.
Thank you.